Well, thank you very much, Raleigh, and thanks for having me here at Trading Pub. Hey, Morgan and Yana, appreciate it. Can everybody see my screen okay? Okay, great. All right, so let us get started. We just want to make sure everything was nice and clear. Okay, so what we're going to talk about here today is how to trade market volatility using options for both profits and hedging, a 7-step plan for trading success. Now, let's see if I get, okay, there we go. So, first off, we're going to look at the secret to profits using option spreads. Then step 2 is how to maximize your option trading profits. 3, knowing and taking advantage of the market maker's secret. 4, what must be done before any trade is placed. 5, critical, what I call post-trade line in the sand. 6, a little known option defense strategy that will change your trading performance. And then how do you bring all of this together? So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. And I appreciate that lead in, and it's great to be here. And this is, Morgan has been a fantastic supporter of me for quite a few years now, so I'm always happy to be doing things with the trading pub. So thanks again for having me. And yeah, I've been actively trading for over 30 years and was previously executive vice president for a company called Transworld Oil and ran their international trading group for over 10 years out of Bermuda. So it's a fantastic experience just from a learning experience plus a living experience. So if you ever get a chance to visit Bermuda, make sure you take it and check it out. So, but we were big in oil, but we later diversified and got into all the big derivative futures markets and foreign exchange. And then we were also one of the first groups to start trading options on crude oil. So did a lot of over-the-counter crude oil options, and that's where I got my passion for trading options. Went on from there and launched an institutional over-the-counter crude oil options brokerage desk for a company called PVM Oil London, and they're the largest privately owned oil brokerage company in the world. So just another really great, learning experience for me as far as learning more about options. And I always tell my members and clients that trading really is a journey, and that it's a fantastic, rewarding job, but because we can do it from basically any place, but you really need to be educated about what you're trading and be very focused on managing your risk. And at times it can also be frustrating and painful profession, probably as everybody here can attest to. Now, when I started trading my own account and not managing money or trading other people's money, had to really shift the way that I was trading. And for me, the real kind of aha trading moment came when I started to incorporate more kind of selling option strategies, income option strategies into my trading. And it's a great thing to add and complement what you're currently doing to also bring you profits from a different kind of stream of income. And it's also a great way for hedging, which we'll discuss here tonight. So the step 1 is the secret to trading profits using options. Now, option trading has so many more advantages than trading stocks, but as you probably know, it's a bit more complicated as well. Now, once you understand the benefits and advantages of option spreads, you'll really never look back. And the key, and I'm going to talk about kind of swing trading, those trades that last more than a day. So to me, the key to swing trading for profits is to use option spreads. And why would you do this? Well, because the unique pricing structures and capabilities that option spreads offer, you're able to control the probabilities that can be tilted more in your favor. I was just looking at everything looks good on the bottom. So when you use option spreads correctly, you're able to keep your capital at risk low. You can define your maximum risk. And it provides great trading leverage. Now, why and how is this done? So I like to kind of look at kind of a process here. So you want to look to kind of in general buy option debit spreads when you have swing trading trades that are kind of strong directional price trends in what I call the early stage of the cycle. So when trading a volatility squeeze breakout, something when you're in a consolidation phase pattern where there's a potential for a big break up or down, that's another time that I really like to look for the debit spreads. And you want to take advantage of also low implied volatility, which that does when you're buying options. But you want to avoid these types of strategies in a late stage price cycle, because you want to, if you get into a late stage price cycle, there's a chance that it'll just stall out, go sideways, or roll over, and that can hurt you, based on the time decay aspect of being long options. Now, the second thing is to sell options or option credit spreads. You can also do that in an early stage price cycle, but you don't want to you want to do kind of these selling options strategies more so in a late stage price cycle. So that's kind of my favorite place. In a late stage or early stage, like for example, I'll show you in a couple of minutes, when you have like a spike low and you have a bottom, sell bull put credit spreads. When you're at a cycle high and the market's starting to consolidate and maybe fade on momentum, I like to sell bear call credit spreads, that kind of thing, to take advantage of time decay. And they're also really great for hedging, to take advantage of time decay. But you want to avoid selling a credit spread or selling options when you're in this volatility type squeeze, which I'll talk about a little bit later. Now here's what to bring it a little bit more clarify stages of cycles. You can see here my pointer. We had this big sell-off, okay, on SPY, or the markets in general, after the Brexit, and you can see that spike down. Now, if you're bearish, you don't want to be selling, options right in this kind of area here on a lower end of the cycle. So you want to be very careful of it, and if you are going to sell it, you better sell, take a shot at selling puts or put spreads. So you're going to want to buy options down here on a low end of the cycle, and then when we get up here, like kind of where we are now, then you start looking at selling options, maybe selling credit spreads out of the money. So you can see here we had a low end of the cycle. We had a really good move up here in May, and then you can see the price kind of trend sideways. Momentum starts to shift, and so this is the perfect place also to start selling what I call out of the money spreads, to take advantage of the time decay. And then it pulls back, and you have another cycle. So you want to be aware of where the market cycles are when you're trading options, and then kind of use the better or more appropriate type of strategies for the various cycles. And so this is what we call a kind of a volatility squeeze. You can see a real tight price pattern here where price is consolidating sideways, and the tendency is to break either hard to the upside or downside. So when you're in a consolidation phase, this is also an area where you don't want to be selling options. You want to be buying options for a breakout up or down, because the volatility is coming in, so the implied volatility is making those options cheaper as well. So these are kind of things that you need to be aware of when you're trading, and really everything basically has some directional aspect to it. Now, the benefits and advantages of selling options and option spreads, and this is what you really need to know to kind of understand what these benefits are. So imagine you're bullish on Facebook and it's trading at $100. Now, as a beginning option trader, you might be tempted to buy, calls that are 30 days from expiration with a strike price of 120, and that would, in this example, cost 15 cents or $15 per option contract. Now, why would you do this? Well, when you do the math, you can see that you're going to be able to buy a lot of them. Now, if you were to purchase 100 shares of Facebook at $100, that would cost you $10,000. But for the same $10,000, you can buy 666 contracts of 120 calls and control over 66,000 shares. So you look at that; that's just eye-popping when you think about it, the leverage that you're getting there. And then you imagine Facebook hits 121 within the next 30 days, and those 120 calls now are trading at $1.05 or 105 per option contract before expiration. You crunch the math and do the math on that potential profit potential, and you can see that you'd make over $59,000 in 1 month. So, at first glance, this kind of leverage really is awesome, but you don't want to let this glitter fool you, because not losing money is just as important as making money. Now, one problem with short-term out-of-the-money options is that you not only have to be right about the direction, but you have to be also right about the timing. And this is what really ratchets up the degree of difficulty. To make a profit, the stock doesn't just need to go past your strike price, but it also has to do it within a defined period of time. So in the case of the $120 calls on Facebook, you need that stock to reach 120 within 30 days to make your profit. So it's this dual objective of having to be right on your direction plus timing is what really lessens the probability of an option trade being a winning trade if you're just always buying options. And my trading profits formula is based on trading high winning type probability trade setups with tight risk management. So you need to understand the cycles and then trade appropriately the kind of strategy, for the cycle you're in. So in this Facebook option trade, you're wanting the stock Facebook, in this example, to move more than 20% in less than a month. And this would be like a 2 standard deviation move. And how many stocks are likely to do that? Well, not many. We'll see the occasional few that do have these crazy moves, but in all probability, the stock would not reach the strike price and the options would expire completely worthless. So based on probability, and that's the other great thing about options, we can measure probabilities theoretically using standard deviation. There's only about a 5% chance for this stock to reach 120 to 121 by expiration. So in order to make money on out-of-the-money options, you either need to outwit the market or in most cases try to get plain lucky about it. And that's kind of the next thing is being close means no cigar. So we used to always kid around the trading room that there's a line in an old blues song that said, if I had no bad luck, I'd have no luck at all. And that kind of tells you which way that luck usually falls for you. Now, imagine Facebook then rose to $110 during 30 days of your option lifetime. Well, you're right about the direction the stock moves, so you get a pat on the back for that. But since you're wrong about how far it would go within a specific time frame, you'd still lose. And I don't know about you, but that's always painful. So based on this trade example, a better goal for every trader is to select trades based on what's going to provide you the most consistent positive returns and not always be looking for that one-time big winner. And consistency, if you're going to stay in the game of trading, is derived from making high probability trades based on reliable data and facts. Now, where there's a big disadvantage, such as the one you saw in the option buying scenario, you can usually just look at the flip side of the coin and see an equal and opposite advantage. So in that case, being a seller of options gives you a huge advantage over being a buyer. So as the pros know this, the professional money, they know this, and they're going to tend to always take advantage of this as much as they can, and so should you. So as a seller, all the things you saw in the Facebook example are the same, but they're going to be in your favor instead of against you. So this again is why professional money takes advantage of selling options, and they do it to make profit generation or income, and they also do it for hedging. And remember that options were created as a hedging mechanism before they were ever thought of to make money off of them. So it's a great derivative for hedging. Now by selling options, if you think about it, you are in essence selling time. Okay, so it's a really powerful dynamic when you think about that. And you can also think of an option, this time concept of an option being like a coupon that you got at a store. You have to redeem it by an expiration date or else it's no longer valid. So, when you're buying an option, you know that eventually that option is going to be worthless. So you have to understand that it is like a coupon and that you need to be aware of that time. So then step 2 is, well then how do you maximize your option trading profits? And knowing how the option pricing works is what you really need to understand these concepts in order to see how it all flows together. So the 2 big components of price for an option, 2 main ones will be time decay, implied volatility. Now when trading options, the most important option factor to understand is that concept of time and the impact that it has on the price. So the time value of an option is also referred to as the extrinsic value of the option. It's the premium that a rational investor would pay over its current exercise value, which is known as the intrinsic value, based on the potential to increase in value before expiring. So, as a buyer of options, you're going to be willing to pay a little bit more because you're going to get more time for your trade to work out. And as a seller, you're going to want more for, giving that person time because time equals risk. So this probability is always going to be greater than 0. Thus, an option is always going to be worth more than its current exercise value. So let's take a look at this next chart, and it'll show you how predictable and powerful this option paradigm is, and then I'll ask you a question on it. So if you look at this time chart here, you can see that when you're 120 to 90 days out, you're going to see that the time decay is very, very gradual. And then as you get 30 days, weekly options, etc., it really accelerates. And before you know it, it's at zero. So we can measure this time decay by what's known as the Greek theta. So it can tell you how much an option will decay each and every day. But think about this. If you've got time decay really accelerating like this, think about it as a tide that's swiftly moving out. If you're trying to swim against that tide, it's very hard. So if you're constantly trying to buy options when the time decay is going against you, it's very hard a lot of times to make money in that kind of environment. Now, think about this next question. So if the underlying, let's say it's Apple, and it was just to go sideways, having no really direction, but the sideways direction, kind of just consolidating, having no really directional trend, would you have wanted to have bought options on that kind of setup 120 to 90 days out? Or would it be better to sell options if you had to make a choice? So if you'd rather, in that situation, sell options, put a number 1, and if you'd rather be a buyer, put 2. Well, the answer is 1. That's right. So, you'd rather be selling, because if it's going to go nowhere, eventually that's a decaying asset. It's going to go to 0. So this is the common natural value, time value progression for all options, and it's seriously like falling off a cliff blindfolded. Now, the next major component for pricing is the implied volatility, and this is expressed as a percentage of the stock price, and this is what is indicating like a 1 standard deviation move over the course of the option cycle, how many days to expiration. And in theory, a stock should end up within a 1 standard deviation price of its original price cycle. This is a 68.2% of the time. Now, this is a theoretical probability or forecast of the security's price range, but it really should be part of your process that you use when you're selecting the highest probability price targets for your swing trades that you're going to do using options. And let's go through and look at this option pricing and how these components work, and then we'll look at it, an example on a distribution curve. But when you look at the value of an option, it's going to again be that time value component times the implied volatility times the underlying, the intrinsic extrinsic value. And once you know these variables, then you're going to be ready and able to price your option and know what option premium you should probably be paying. Now, here's a table that we can go through and show you how this kind of time value in option pricing works with these components. But when you look at a weekly option, you get a new weekly option series every Thursday. Okay, so most of the options now on the big stocks and everything will have weekly options, which is great. And when you look at the time value, so that first day on a Thursday, you're going to have 100% time. All right, so then time times the implied volatility times the underlying value, that equals the premium or the price of the option. So the first day, you've got 100% time. And in this example, let's say implied volatility was 300. I'm keeping this at a constant number so you can see how these two variables impact each other. You would have a price of $300. Now, when you look at Monday, you can see time value is cut in half. And even if you increase the implied volatility in this example to 800, you can see that your premium only goes up to 400. So it really didn't move that much more from 300 to 400. Now, let's say your implied volatility, though, is only 300. And now half that time value component's gone. So your premium of your option would be only $150. So you can see how these two work. And the other thing, too, to be aware of is that time value goes to 0 at expiration and implied volatility goes to 0. So you better be aware of these two big parts of component for pricing options, if you're constantly buying. Now, step 3 is the market maker secret, and it's what you really kind of need to know. So this is some really important concept to understand when you're trading options, and this is the implied move and expected move. So when you look at markets and price, you'll see that the broad markets will tend to have cycles. They'll maybe go up 2 weeks or 3 weeks up or down, and then all of a sudden, we'll have that sideways churning type of price action. And that's going to be the markets are going to churn and go sideways in some kind of channel 70–80% of the time. So they're going to be more, channeling sideways than they are going to be on these extreme trends up or down. And it's based on this sideways price movement that, the out-of-the-money option buyers in this kind of environment will statistically lose about 70% of the time. And the market makers, they know these statistics. They're out there and they know the statistics, and therefore they're going to tend to trade from the sell side as much as they can for the advantages that gives them. And this is the professional money. So if you can think like the market maker, it's going to really change your performance as well. And it's all about the math and the math of probabilities. So market makers, they use mathematical market probability statistics to price the movement of an option to its expiration. And by knowing the probability of your underlying security finishing within a certain price range at expiration, this is really key when you're trying to determine what options you want to buy or sell and what option strategy that you want to implement. And this is also the key concept when hedging a position. So if you can understand this concept, it's going to give you some great information and a great way to help your overall trading. So it's this statistical forecast. This is what we call or refer to as the implied move of the stock. And it's this implied move. This is an estimate, a theoretical estimate of a plus or minus 1 standard deviation move of the underlying security. So that all sounds very complex and complicated, but it's really not. So let's take a look at this distribution curve, and it kind of gives you a little clearer idea of how this works. So, if you've ever taken any stats or whatever, this is what you call that normal distribution curve, that bell curve, and it just kind of shows distribution of data. And in this example, it's a distribution of price. So based on probability statistics, and trading is all about probabilities. So when you're selling options or option spreads and you're doing it correctly, this will provide you the highest probability type trade setups for both profits, and it's a great way to hedging, and it's all about the math probabilities. So in this example, Google, the implied move, this is all information that's going to be given to you on your option platform. So it's not any mystery where this comes from. And everybody now, we all have pretty much the same platform, so we're going to get the same information that these market makers are getting, right? Now, in this example, you've got 500 at the top of the bell curve. This is the at-the-money price. That's where all option pricing starts. That's where all supply-demand starts. So that's the first strike price that's determined. Once that at-the-money price is determined, then the out-of-the-money strikes are determined for your calls and your puts, and that's called the option skew. Now, in this example, we're given an implied move of 4% up or down. So you take that from your at-the-money price, so that gives your 4% down would be 480, 4% up in this example is 520. This is what we call the expected move, the implied move of the underlying. So it's implying, the market is theoretically implying that Google, trading at $500, should theoretically trade between $480 to $520, 68.2% of the time, which is 1 standard deviation, over the cycle of its expiration, in this case 10 days. So by knowing this information, this is the first place that you want to start before you put your trade on. What is the expected move? So in this case, if you're trading Google, you can say, okay, the expected move is for $520 up, or it's for $480 down. So this gives you a realistic price target to trade. So if you're maybe buying right here at 500, you can realistically think, okay, I do have a realistic chance to go to 520. But if you're thinking you're going to go to 580, you're not being realistic. So let's say 580 is down here, way down this curve, and that's only 2% probability. So, buying a 580 strike, even if it's cheap, maybe it's 15 cents, you can see why it's cheap, because the probability of that price getting there in 10 days is only 2% based theoretically on these, expected move. So this is where you should always start your trades out when you're looking at a certain trade. When you're trading options, always first know what is the expected move up or down, and then use that as part of your price target analysis. And we'll go through that a little bit more. Now, again, trading is a business of probabilities. And to be successful, you really need to be focused on controlling your risk. And one important step is to know the winning probabilities of any trade you're taking. And that's where that expected move comes in handy. Now, you're not going to probably have a lot of time when you're trying to make the trading decisions to use your option platform, the model that you have there. So one of the really quick and easy ways to determine probabilities of a trade is to use, and this is free on your option platform, is to use the option delta. Now, the option delta, it's used for kind of two main things. It'll tell you what the value of the underlying security will be, the option of it would be based on a certain move. Usually it's up $1 or down $1, then it starts kicking into using that option delta. But the other way it's great to use is to measure the probability of a price move on the underlying itself. And this is how I use it so much. Now, if you go to your option platform and you see a strike price that has a delta of 68 or 70, you look at the strikes and you go out to the delta column and you see a delta of 68 to 70, you can also use that to equate to a 68 or 70% probability that that's where price will be at expiration. Okay, so that's a great way to know. Now, if you looked at an option delta and it's 16, then that's telling you you've only, that particular strike price, there's only a 16% chance of that price being at that point at expiration. So if you looked at this bell curve again, this outside point right here, 520, is that 15.9% area. So for Google in this example, is that 15.9% area. So for Google in this example, it'll be at 520 at expiration. That's about a 16% probability. So this will have a 16 delta when you look at your option platform. So that would be a 16 delta, and this would be a 16 delta over here. So, if you're out here buying these strikes at 480, then, you can tell yourself, well, I've got a 16% chance that Google can be there within the day's expiration. Now, if you come down here and you have an option delta of 2 or an option delta of 5, that's only telling you how much percentage. You only have about a 2 to 5% chance that price will be down here at expiration. So this gives you the information you need to start your trade analysis out with. It's really important once you do this, and you need to kind of do it step by step. So using this probability analysis, it's going to provide you a very useful tool to determine price targets to trade against, and that's going to be also what you need for setting up your hedges. So if you can see that the probability of price, getting to a certain strike price is only, 15%, you might be willing to sell a hedge there, right? Because there's a low probability of price getting to that place based on the mathematical probabilities, and you can use the delta to help you with that. So based on math of probabilities, you can see that, 68.2% of options that are bought out of the money are going to expire worthless. And based on this, it's always a good idea to look at the sell side just as much as you look at the buy side. So it's going to be this added strategy for either profits and hedging. It will make a really dramatic difference in your trading performance when you start using it correctly. And again, it's why the professional money takes advantage of selling options for profit generation and risk management, and that's also the reason options were created. So then step 4 is, well, what must be done before any trade is placed? So I always religiously try to point to my members and tell them, clients and members, before you ever put on a trade, you need to do 2 things. Always have your profit targets defined. Where do you think it can go? So we can do that. We can theoretically use these tools to give us these targets, so we can use this expected move. And then the other thing I like to use is Fibonacci, levels, support, resistance, or extensions. So before I ever put on a trade, I always know what are my potential profit targets based on the expected move and Fibonacci. And then 2, always have an exit plan before you put the trade on. Just don't put the trade on just because you feel like it, right? Always have an exit plan. So that should be where your stop's going to be. And do you have a trade defense if you want to defend a trade? So if you have a defensive plan, know what that is. Where are you going to defend it? That's that line in the sand. And then how are you going to defend it? What's the strategy? So let's look at profit target define. Now here's how I go through a trade example. So this was on AZO. This was on June the 28th. Okay, so it looked like a potential good trade setup. It was in what we call volatility squeeze, maybe breaking to the upside, and it was trading at $790. So the July monthly expected move, this is the first thing I look at, was for right here. See, this is Thinkorswim platform. It'll give you the expected move here, but all the expected move is the straddle price. That's what the expected move is. In this situation, though, I'm given the expected move right here. So it's $25 up or down. So when AZO was trading that day at around 790, the option model with 16 days to expiration was given the expected move of $25 up, which would be 815, or $25 down, which would be 765. So that's the expected move. That's a realistic price target, either up or down, for AZO, trade at 790 on that day with 16 days to expiration with the implied volatility 18.64%. So this is the first place you started. So, okay, 815 is a possible target. Okay, so that's to the upside. I wanted to look at an upside move. Now, here's what it looked like on a chart. So that's what I talked about, that volatility squeeze, consolidation phase. When I see that, I get really excited. My momentum indicators were showing up. So potential was for a break to the upside, so I wanted to look at a trade setup. And so I looked at the expected move and ended up putting together an option trade with the 790 right here, 800 call spread. So the expected move was up to here on the options, about 815. You can see Fibonacci, the prior high was right here about 810. So if I did a trade setup that was inside of that with my target, then I've got a pretty good shot of making it. So what I'll do is, if the expected move's at 815, I'll have my profit target before that. So in this particular trade setup, it was buying the 790, selling the 800, $10 wide call debit spread, which had a pretty good potential for making that run to the upside. So here was a trade setup on this. It was a debit spread, buying the 790, selling the 800. $3.55 call debit spread. So I had my expected move. I looked at my Fibonacci target levels, I knew what those were. So that gave me a good potential trade setup. And then the next part was, okay, well, what would be my stop loss? So a real simple stop loss rule is, you can use 50% of your debit paid, or if it's a credit spread, 50% if it goes against you. So in this case, 355 was the debit. So let's say it goes down to 170, 175. That could be my stop. That would be my stop. So, basically risking 175 to make the maximum width of that spread. And then the defensive strategy is step 5. And this is what I call that post-trade line in the sand. This is where you need to know what area, of a price movement where it breaks, you defend if you're going to defend. And what I mean defend is if you're not going to stop out, but you want to take some type of defensive adjustment action where you can still stay in the trade. And in this situation, for me, it was either if AZO came back down to this 618 retracement right here, which was about 780, and started to look like it was going to go through there and close, that was my line in the sand. Then I would take some type of defensive action, which would be either to possibly stop out of the trade, or set up a defensive adjustment, which I'll show you in a little bit. And then step 6 is the option defense and more. So this is where we get into talking about what is the kind of defensive strategy that you can do. Now, before we go there, though, selling options and option credit spreads, this is the key. And the things that is so great about when you sell an option, you have to remember, if you're just selling a naked call or put, you've got a lot of exposure. So the credit spread eliminates that exposure because it is a spread. So these are a fantastic way to trade for profit or hedging. And the reason is that they can work regardless of market direction, can work even if you're wrong, which is pretty awesome. The winning probability of profit when you're selling a 1 standard deviation out of money credit spread is theoretically 68% as soon as you put it on, and that's even without adding technical analysis. So if you've got good technical analysis and you've got system that's better than 50-50, that increases that probability even more. And then it's the perfect way for hedging. So for these credit spreads, there are three basic types. You've got the bear call credit spread, you've got the bull put credit spread, and then the combination of the two is the long iron condor. So the bear call credit spread is, if you just sold a call naked, that's okay. If you're familiar with it, if you're aware of the risk. But if you don't have a portfolio margin account, you're not going to be able to do that anyway. So, but one way you can do it is selling a credit spread. And I prefer to do this because I know what my risk is. So basically it is selling one call with a lower strike while simultaneously buying another call with a higher strike same month. So you're protected. So here's an example. And this is, you can see here, this is SPX, and it's on this example trading down here at 1988. Now look where this credit spread was set. It's way up here. This was like one standard deviation above the market. So as soon as that trade was put on, theoretically, there was a 68% probability that price would not get up here. Okay. Now that's the thing that's beautiful. That's the beauty of it. So you can see that the short strike was 2045, the long strike's 2050 above it. So you're way above, where the price was trading. And what this does is takes advantage of the market just kind of going sideways, time decay erosion, or going down. So collected $100 credit, the risk is the difference of $400, and that's your margin that you have to put up. Now, as long as it stays and closes below your credit spread here, your short strike, you keep the $100, and that's a 25% return. So these are, nice, consistent, potential type of income returns that you can do. And, this usually I'll go out on something like this anywhere from 5 days, 10, 15 days out. Okay, so, you can set these up for 20, 25% return type setups. So that's what it looks like on a bear call credit spread. Okay, it's a bearish strategy. Now, the bull put credit spread is a bullish strategy if you think the market's going to go up. You could just sell a put out of money, but then you're going to have a lot of risk. Or you could sell one put while buying another put with a lower strike in the same month. So that's your bull put credit spread. And this is an example of that. So you can see in this example, it's trading right here. This is when it's trading at $207. Now you're bullish, so you could either just buy calls, you could buy stock thinking it's going to go up, or you could do a bull put credit spread. In this situation, you were selling way down here, the 187 put, buying the 182 put below it. So it's a $5 wide spread as well, way down here. So you can see it's below that prior low, and it's below where when it was trading at the time. So a lot of room down here. So as long as it closes above that, you received $130 credit. The difference is your risk, $130. So if you did nothing at all to defend this trade, and it goes through your spread, you lose $130. So that going in, that's your max loss. But you can defend these. There are adjustments you can do, which we'll talk about. But if it closes above here, you keep the $130. That's a 35% return. That's a bull put credit spread. So it's a great bullish strategy. Now, the next one is the long iron condor, and all that is combining the bear call credit spread, the bull put credit spread together, and you just get additional credit. Okay, we won't go through that one too much, but here's the key stuff right here. Profits and hedging using these credit spreads. So this is kind of the aha part of this presentation. When you look at the risk to reward of two, in this situation, example, it's going to be looking at the risk to reward of two long directional option strategies. The first strategy is hey, let's just go long. Okay, we're going to buy directional calls. Okay, we're bullish, market's going up, let's just buy calls. The second strategy is also bullish, but it's going to be selling a out of the money bull put credit spread, also a bullish strategy. So let's compare the risk reward. So in this example, it's when, and it's trading at $207. Strategy one is to buy the at the money June 207 calls. They were $11.40, so that's $1,140 per one option contract. It's a great strategy if you think the market's going to go up, infinite potential upside, profit. Your risk is your premium paid, $1,140. So, it's a good strategy, but you're directional dependent. It needs to go straight up for you to make money, and it has to do it within a certain defined period of time, or else that time decay is going to kick in. Plus, it might be a little expensive for you for, maybe for your account size. Now, strategy 2 is also bullish strategy, but this is selling an out of the money bull put credit spread. So selling the 187 put, buying the 182 below it. And this was about 1 standard deviation. So it was, the low was 189, and this was like 9.5% below where Win was trading. So let's compare the risk to reward on these two strategies. So in this second strategy, okay, so we're going to compare the risk reward on both. Let me show you. So strategy 1 is you were just buying the long call options, okay, the 207 strike. You paid $1,140. So John was very bullish, so he bought this strategy. He bought these at the money calls. And on the 8th of May, the market had, as we've seen so many times, it goes up and then it craters down. So John looks at his P&L and he can see that, the market looked great, and then all of a sudden just kapoop, that waterfall down. So John's holding his breath. He opens up his P&L, on the 8th, and he looks, he's down $583 on his option contract. So, that's smarts. So not too good. It was trading at 196, So when you put it on, it was trading at the money, and now, he's down $583. Now, on the 21st of May, John, sees that, well, the market's gone back up to 205. It's not, it's only $2 below where it was originally. So John opens up his P&L, and he's still down $518. So not much better, and the market's come back up only $2 below where he actually set the trade up. So he's pretty bummed out. Now, Susan was bullish, but instead of, just buying direct calls, she did the bull put credit spread. And so she sold way down here. You can see Win was trading at 207, but she sold way down here. The 187 puts, bought the 182 below. She got $130 credit. Her max risk was 370. If everything worked out well, she would make 35% return, and that's good. Now, she opens up her P&L though, on May 8th, it's 196 trading, and she looks over at her P&L, and she's only down, she's like holding her breath, but she's only down $38.50, whereas John is down $583. So a big difference there. And then finally on the 21st, Win comes back up to 205. Susan opens up her P&L, and she's expecting, not knowing what to expect, but she can see that she's actually up $78.50, and John is still down $518. So this really highlights the difference between two bullish spreads, or not spreads, but two bullish type trade setups using options, but the difference in the risk to reward is huge. So this is where you can put it to your advantage when you understand how to use these types of spreads. Now, the credit spread is also something I call the most forgiving trading strategy ever. And it's also can be used for offense, for profit, or it can be used for defense, for hedging. So here's a trade setup to illustrate both concepts. So this was originally a short bear call credit spread. So it was set up to look for a market to either go sideways to down, okay, to take advantage of the time decay. So the setup was on the 23rd, and this was back when in February, everybody remembers February now, where we had the market bottom. So we had a big sell-off here. So it was based on a directional trade. Big sell-off, came down to that 1812 level. Then we had a bounce. So this was a 50% retracement level right here. So it bounced, and then it faded right there and went back down. So when it came back up again, sold a bear call credit spread, 1 standard deviation out of the money, looking for this to roll back over again at that 50% retracement. So with Fibonacci, you either get, a lot of times you'll get that retracement failure at the 50% or the 618. So my short-term momentum was showing me down, so I went ahead and took the trade setup there, selling out of the money, bear call credit spread. But when I had that trade on, before I even put it on, the market was trading at 1940, And my hedge was, the line in the sand was if it broke, the price penetrated this 1946 level, that's the 50% retracement. So that was my plan going in. I had that set up. If it pierced that, I was going to hedge it. Okay, so that's the line in the sand. Now, this is what the trade setup looked like. It was way out of the money, about 1 standard deviation out of the money. You can see that it was trading right here, and then it did. It rolled over, had 2 days straight down. It was looking great. Remember, if you remember that day where it came up, that candle, that's kind of what we call the hammer. And so it came back up above those moving averages. And so my decision was if it came back, if I had a price break, just a price break, didn't even need to close, I was going to hedge it because I knew what could potentially happen. And so it was sold on this day. And this day it came down. It looked great. And then it shot back up. And on this day it was hedged. That was the 25th. So the original price was 1940. The spread was a 1980, 85 bear call credit spread. Here's the short strike in red, long strike right there. That was about 1 standard deviation over out of the money, giving me a 68% probability going in. And even better, with my momentum going down, that my odds were actually greater because my system's better than 50-50. Now, but I had a plan if I was wrong. So here's what the trade one looked like. Market was trading at 1940. It was a short bear call credit spread, expiration the 10th of March. So sold the 1980 call short, bought the 1985, all simultaneously to make it a spread. It was set up, 1 standard deviation out, about 68.2% probability when it was set up. The credit received was $100. That would be your max profit. The margin would be the difference of your capital at risk of $400. And if everything went smooth and you kept that $100, that's a 25% return over about a 15-day period. So not too bad. So 1980, 85 bear call credit spread right here. That's what it looks like. Now, the hedge was if it broke and a price pierced that 1945 level. You can see that arrow. That's where it did. On the 25th, I didn't waste any time. I went ahead and hedged it. And I'll show you what I did here in a second. Now you can see that the next day it went up and then it came down and then it just shot through the roof. So when you have your plan, stick to your plan. Don't waffle on it. Just go ahead and stick to it. Sometimes, it might not be the right thing, but just always stick to your plan. So the 25th, it was hedged when it broke that 1945, and then it actually went way up to 1975. So here's what the hedge was. On the 25th, when it broke that 1945, I bought a call debit spread, same expiration month. So I bought the 1975 call, sold the 1980 call against it. That's a bull call debit spread. Now, when you do that and you're sharing the same short strike, which I'll show you in a second, that's what creates the beauty of this hedge. Now, this costs $165. That's your debit. That's the max at risk. Now, just on a pure spread basis, you're long the 1975 call here, short the 1980. Cost was $165. Your potential profit's $335. The difference, right? So here's the debit. So it's a 1975, 1980 debit spread. So here's what the trade now ends up looking like. So trade one, the original trade, short call, bear call credit spread, sold the 1980 strike short, bought the 1985 long. There's my bear call credit spread. Okay, got $100 credit into the bank. Now, it broke my line in the sand. So I bought the 1975 call, same expiration month, sold the 1980 vertical call debit spread. Look at this. Here. This is the key. The same short strikes are shared, so you have actually two shorts at that strike. And what is that? That creates what we call a balanced symmetrical butterfly. Now, by doing that, a couple things that it helps you to do. So the original spread, you got $100 credit. Okay. Now, if I did nothing else and the market took off and I didn't, deer in the headlights, my at risk, my maximum potential loss is $400. When you're trading, you never want to lose your full amount of your capital that you have at risk. That's what and especially when you're doing credit spreads. So by converting this when my line in the sand was hit, before it got close to my short strike, I bought that 1975-80 call spread. That reduced my capital at risk from 400 to $65. Huge difference. So not only does it save you in the pocketbook, but just emotionally and from a standpoint of, kind of your emotional part of your trading, it really helps you to take the stress of the market. So in this, once that butterfly is put on, then you can sit back and then think about the direction. So the most I could lose is if it went down 65, if it went up 65. So I like that. So here's the 1980 bear call credit spread, 1975 debit spread, put them together. You've got your butterfly. Now, then the next thing is getting out of it. So if you did nothing and it expires outside of your butterfly, you lose $65 in that situation. But, you've got other options now. You could either sell another credit spread or you could buy a debit spread against it. You can create what we call an unbalanced butterfly, which I won't go into that, or you can leg out of it, or you just leave it alone and go for the, what you do is you try to create a campaign of these. So you do another credit spread once the market starts to stall, which I'll show you. So in this one on the 8th, what I like to do is when I do this type of hedge, I'll wait a lot of times close to expiration, because then the theta decay is really stripped out of that credit spread. So in this particular case, the market had really spiked to the upside, and then it was starting to roll over the day before expiration. So what I did was I went ahead and exited the lower the day before expiration. So what I did was I went ahead and exited the long call debit spread, which was on at $165, closed that out at 335. So from 165 335, that was a $170 profit on the debit spread. Now on this day, I used a 5-minute time frame, and so it kind of peaked out there and then came back down a little bit more. So as it was coming down here, then I waited as long as I could before it started flattening out, and then I bought back, closed out the credit spread side at 245. Okay, so I lost $145 there, but made $170 on the debit spread that I put on as the hedge. Lost $145 there, so ended up making $25. Not a big deal, but the key is when you're trading, you want to manage your risk, keep your losses to a minimum, and in this case, make money. That was a 6.25% return over 14 days. So $25 profit versus a $400 loss. That's what you're looking for, and that's what you want to do when you're putting on a trade. Have a defensive plan if you're going to defend, and know what it's going to do for you in case the worst case happens. So that's how that happened. Now the next thing that you want to do in this kind of situation is then put on the next trade, do it again, but wait until the market finally does give you that peak that you were looking for, that momentum shift. So this was actually the last part of the trade, was just to set another bear call credit spread, trade 4, when the market actually did turn over, and at that point it really shot up. So the market was trading at 2052 then. So set the 2070 bear call credit spread short, 2075 bear call credit spread, and this one bought in $120. The market finally did roll over hard, closed that out on the 29th, bought it back for $5, so made $115 there, 30% return. So that combination, I call it kind of a campaign. That's how you have to look at your trading. You can't just look at one trade and let it go and lose. You've got to manage all these trades. Now the other great thing about this kind of defense is that you can do it the other way around too, which I'll talk about here in a little bit, but you can do it either as a credit spread defense or a debit spread defense, because really there are two vertical spreads. So you just, whichever position you have on, if you're like a debit spread that's going against you, you could sell a credit spread against it. So it's a really great, easy, quick strategy to incorporate, in your trading, and it's just going to make the biggest difference to your emotional state of trading too. Which, if you have good emotions in your trading, you detach your emotions, and you're confident about what you're doing, you have a trading plan, and you stick to it, it's just going to make you that much better, on your trading. So I highly recommend that hopefully this is stuff that you guys can kind of start piecing together and go back through here if you want later and watch it again. So step 7, though, would you like to learn more about this option profits hedging strategy that capitalizes on time decay? So what I've put together here is a really great package for Trading Pub, actually, and this is I call it How to Sell Options for Profits and Hedging. It's my Make Money Blueprint and Review Workshop course that I did. So it's a 5-hour course on demand, 30-minute modules, and here's the link. So please take advantage of it, but it's going to be a fantastic offer, plus a money-back guarantee if you don't like it. But the thing here, you look down here at $97, but look at everything you're going to get here for this package. You're going to get this 5-hour on-demand course. It's broken in 30-minute modules. My courses are very detailed. You're going to get the 270-page training manual. So this is a PowerPoint, very detailed, lots of examples. I'm a visual learner, so that's how I teach. And then just this last Monday, I did an on-demand live review workshop for this course. And this workshop is focused on the hedging part of it. So that's part of the course as well. So you get that. That's another 2-hour part. And then you're going to get a couple more bonuses. My option strategy manifesto. It's a great diagram of some of the best option strategies that you can print out, put on your desk. Greek power tool guide you can put on your desk. And if you've never been a member of my trading club, you'll get a free month to that. So all in all, just a great way for you to look at trading options and look at how to hedge with options. And you have zero risk because I'm also offering you a money-back guarantee here today. So use that powercycletrading.com/win, and I'll give a little bit more time here to show you more detail. So it's my course that I did. This course was done about 2 months back, so it's a real fresh course, and it's again trading option credit spreads for profits and hedging. 5-hour on-demand course, 270-page training manual. Then you're going to get my recorded selling options workshop that I just did Monday night. Plus, I'm going to do another live follow-up support Q&A. So if you have any questions on the course, this will probably be in about 2 weeks. You'll get an email and a link for that. My power tool guide. This has all the Greeks for you. Option manifesto, 1-month membership. The course itself, this was the course I did, just a review course Monday night, so you're going to get that. And this course, but it was more of a review workshop. We just went over the hedging aspects of using options. So just to really get your clarity on how to use these type structures for hedging. But the course covers the profit side, the hedging side as well. And here's just a little feedback. This is from Charles. Thank you for the wonderful credit spread option course. The class was so thorough and expansive and immense flexibility of credit spreads. Thanks, Larry, for all your efforts to help traders. It's so inspiring to hear an option professional with your vast experience helping others up the ladder to a new level of understanding on credit spreads and risk management. So really appreciated that a lot. And, it's always fantastic to get good feedback from your clients. Now, the option, this is a really great little handout for your desk. You can print this out. It's what I call my Greek power tool guide. And it's just a quick reference guide for all the Greeks, So if you're like, what's the gamma, delta, theta? It's, you put it right on your desk and you can have it right there at your fingertips. And then you're going to get my other bonus, 15 option strategy guide. So this tells you what these particular option strategies are with a diagram and a brief explanation of it, like a back ratio spread or a covered call, protected puts, things like that. So this is also you can print out and put on your desk. Now in the course, this is what's outlined, or this is the outline of the course. So it starts out with the option Greeks that are important to selling options. So it's not real, it's just going to go the practical Greeks and how they're used for these options. And then I go through how to use the credit spreads to create these low risk, high probability trades. Now this is right here, this is actually really what's worth the course and more. So if you're not understanding how to hedge your positions, You need to get this course. How and when to use credit spreads for hedging a core trading position. So this is a big chunk of the course, and this is that review workshop I did Monday night, was 2 hours just on this. So just on this alone, it really will make a difference in your trading. Trust me on that. And then how to use credit spreads for stock indexes. I love to use SPX, NDX, RUT. There's no assignment risk. It's just a lot of great ways to use those. So that's a big part of it. When and how to do a deep in the money credit spread. This is where you create your risk reward ratio to convert it to positive from a negative. So that sounds confusing. This shows you the other way to use these credit spreads where you can go deep in the money. And then you can see, you can take a small account and start growing them, with these kind of small kind of plays, and turn into, a larger account. So it's a real good way to set up a smaller account, start, doing some consistent type trading to start growing your account. And then a big part of the course too, again, is when you have a credit spread, you don't want to ever lose the whole amount of your max loss. So I teach you 6 defensive strategies for different market conditions, different adjustments that you can do and make to defend a credit spread that you put on that's starting to go against you. So this is a big part of the course too. And then when to use an iron condor, when not to. I don't use them that much, and I'll show you why in the course. Position sizing. So if you're trading a lot of different size, if you're doing a bigger position size, teaches you how to add that credit spread to diversify your risk. And then the really great thing is when you're selling those out of the money credit spreads, how do you convert that 68% probability, 70% probability, and a greater winning percentage? Some technical little things there that you can do. Step-by-step guide to executing the spread. Some good technical analysis tools, a little Fibonacci work there for your technical analysis for these spreads, to know where to sell and where not to. The best market times, when do you do these spreads? Should you do it 5 days out, 10 days, 30? And then when do you take it off? Then how to trade these spreads into the day so you don't have to be glued to your charts all day. And then I also give you a credit spread library of a lot of past trades that you can go and look back at and see what, how they were set up. And then for anybody here that's never been a member, I'm also going to throw in 1 free month to my trading club, which I have a virtual trading room. We're open every morning, 9:10, 9:15 a.m. Eastern, and then back, close at 4:15. I'm in the first hour and a half in the morning, and the last hour, doing day trades, futures, do a lot of different future type trade setups based on my trading system, option trades on any swing trades we're seeing, using either credit spreads, debit spreads, any kind of hedging that we may do a lot of different butterfly type trade strategies, earning strategies. So a lot of stuff there going on in the trading room. So that's part of the trading club. Do a daily aftermarket video every day after the market closes, a newsletter video showing you what's going on during the day, what trades we did, what we're looking at the next day. Do a live Q&A every week, hour and a half every week, and come in, ask whatever questions. We have a Trader's Education Vault, a lot of good educational material. And then every month, you're a paying member, $97. You'll get a $20 credit that you can use towards any courses or any of my trading models. I've got a lot of different trading tools, and then discounts on anything that, any of our courses or upcoming courses. So everything, and just a $97 and a money-back guarantee. Hard to beat this for my friends at the Trading Pub. So hopefully this is some stuff that you can start using, over the weekend or tomorrow or Monday. Gives you some ideas, hopefully today or tonight, what I showed you that you can start incorporating in your trading. And then if you want to get more in-depth detail about it, please take advantage of this offer. So let's see, any specific questions here? So it's powercycletrading.com/WIN. See if I see any questions. All right. Well, I appreciate everybody being here. This is both. You can do this. These are option. When you do a option trade, you can do it on stocks, ETFs, or futures. These particular types of strategies, work with anything basically. So it's just basic option concepts. So it's just understanding the option concepts and then applying it to what you want to use. So if you like to trade stocks, you can do it with that or ETFs. So when do you use the in the money spreads? Well, if you the in the money spread is something that you can use when you have good high implied volatility, and you can use it as a directional trade. And what I like to do is use the in the money spread when I can do it, say where I get like a 50-50 risk reward at least minimum, something like that. So if I'm gonna risk $1 to make $1, and it's a directional trade where there's high implied volatility. So I like to look at that, or I'll sometimes even do the in the money spreads where you can get a positive risk ratio where it might be, instead of 50-50, it could be 60-40. So from time to time I'll use those. Yeah, so the implied volatility, as it goes down, then you want to shift your focus a little bit more so to buying volatility. Okay, so you have to adapt your trading. So that's why earlier in the presentation I said that you need to look at your cycles, right? So when you're at the lower end of the cycle, you might want to look at buying or selling, but the volatility is a big key. So at times when the volatility is too low on a certain stock, you're just going to have to pass on it. But when you're doing the index options, even though the implied volatility goes down, they're still still pretty decent. Usually in any kind of market, to do certain credit spreads out of the money, you can still get enough credit for those. But you need to look at that. So when you do have a very, very low implied volatility, that sure does make a difference. So, yeah, correct. That is correct. So any other questions? I like to use, I'm a directional trader, so I like to use any of these trades that I'm setting up with options will have a directional, component to it. So, for example, when I'm up at the, when we're trading a market and we're, up at the low end or top end of the market, I'm going to always fall back to my trading model to help me decide what I want to do. Do I want to go long? Do I want to go short? And then I'm going to then structure the trade based on the direction my model's given me. If I can find my chart here, I'll show you. Oh, hold on, I'm trying to pull up the chart, but trying to pull up my trading model here. Oh, there it is. So what I like to do is use my model, to set my directional parameters, and then I'll trade according to the direction, using options. So I just have to have Apple up here, but you can see Apple's had a great breakout. Now, when you start seeing momentum start shifting to the thing I'm really watching closely now actually is the RUT, the Russell 2000. I'm looking at the Russell 2000 and the SPX or the S&P for setting up some bear call credit spreads. So I think we're about, see, we came up here to we hit the 1272 extension. If you look at the Fibonacci levels, and I think we're going to here start to stall a little bit, and you'll see us probably consolidate and start pulling back. So we've hit, we're so extended, we've hit all these different Fibonacci levels and exceeded it. So what I like to do is trade momentum and price action direction. So right now you can see that the momentum to the upside today was still really strong. So what I'll be looking at over the next, probably after tomorrow, because tomorrow's monthly option expiration, so we're probably not going to get too much of a price change. But I'll be looking closely Monday. Plus, we have seasonality kicks in towards the middle of July, towards August, and the seasonal aspects of the market tend to come off. But so I'll be watching my model here, and this is a directional momentum flow indicator, part of my system that I just put together here. But as we start turning over with momentum, when I start seeing these algos start going red, then I'll be looking to set up a bear call credit spread probably on S&P 500, and that would be probably what I like to do is use the SPX. Because the SPX is an index, so you have no worries. It's cash settled. The other thing, you can do SPY, but if you're doing more than one contract, the SPX is like doing 10 contracts of the SPY. But what I'll be looking for is this momentum to start shifting, and then I'll come out here. And if we're trading right here, see we hit that 1272 extension. That's the Fibonacci level that the markets usually struggle at. So I'll be looking here, setting up a bear call credit spread, one standard deviation out of the money. And again, I'll use that delta to establish where that one standard deviation will be. That's how I use it real quick. Set up that bear call credit spread. It's probably going to be just eyeballing it, probably 2180, 85, something like that. So far enough out of the money, that would be probably 5 to 10 days out. And try to get something. I'll try to get a minimum of about $100, which would be about a 25% return. So that's what I'll be looking for, kind of on a directional basis. Yeah, the count balance. Yeah, probably $5,000 would be ample. TJ, send us an email. If there's something on your course that you need. I'm not certain, but just send us an email. If you have any questions at support@powercycletrading.com. So that's what I'll be looking for on the S&P, and also the Russell is going to be I think usually the Russell tends to kind of diverge and start going up first or going down first, and so I'll be watching the Russell 2000 here closely too, and so I'll be looking to set up a bear call credit spread on the RUT, so you can see see the momentum. Look at the difference. It's come off a lot harder. You can see if I flip back over to the S&P, just look at this momentum flow indicator. You'll see that it's still pretty much kind of green bars, but you can see the Russell is starting to shift. Momentum starting to shift down first with the Russell, and that's usually a kind of a first sign to some divergence in the market. So here's the S&P futures. So it could be tomorrow. See the S&P futures here, still a little bit stronger, and than the Russell. So that's what I like to do. Now the other thing is the main thing to apply with your trading is that again, when you put the trade on, have a plan of action what you're going to do if the trade goes against you, or have that plan of action where you're going to take profits. So again, I like to use the Fibonacci levels. So we had a nice setup that we had a CME had a long call spread on that, and went ahead and took profit on that today because it was into these fib levels, the 1272 extension. See, it hit up here. So put on back 2 weeks ago, put on a 100, 103 call spread, very, very cheap, low defined trade. And today got a nice gift when it exploded and hit that 1272 extension. And that was also what we call a weekly squeeze. It triggered out of a weekly squeeze. So this trade setup was based on a couple factors, but a big part of it was this weekly squeeze. See this consolidation, these dots that define my trading system, what a weekly squeeze is, or a squeeze. So set up this trade based on the week of earnings to take advantage of an increase in implied volatility. So did a call spread and got a pop to the upside today and just went ahead and took that off. So that was on CME. And now just kind of sitting, waiting. Sometimes trading you want to wait because I don't want to be chasing the markets up here when, like I just showed you, they've reached a lot of these Fibonacci levels, especially when you look at hitting the 1272 extension. That's definitely a place where you want to be taking profits, and you don't want to be setting new longs. Doesn't mean it can't keep going up, but it's not an area where you want to be aggressively buying the market. And this is again a late stage cycle up here. It could keep going up, but when you get to the 1272 extension, that's part of that cycle work that I look at to be kind of a late stage cycle. Now this is a weekly, so you can see how this huge move has been to the upside. And then the other thing I like to really take note of is the where we are as far as based on your moving averages to see how extended you are, because nothing keeps going straight up or straight down. So you'll see that we're very extended from this 21 EMA on the weekly, and when you get real extended, you can see any other time, try to look back the last time we were this extended, you'd have to go way back here, but it won't stay up here very long. And then the other thing you want to do is keep a close eye on your VIX volatility, and when it starts pushing back up, I'll show you here in a second a couple things you can look at there. But you can see here, the last time we really had a really big pop, well, we had it back in, well, here's an example here. You can see that low back in October. And then you had that just huge move. But see how extended it got from the 21. Eventually it has to come back and revert. And that's a really good reversion using the 21 EMA. And then I guess let's take a look at the February time frame as well. Okay, here's another October time frame. Not too extended. But see, back the last time we were extended, see the February move? We're about the same extension. So you can also use Fibonacci to look at your extension levels, which I like to do. So if I take a Fibonacci extension tool here, and I go from, about right here, this point here, to up to the high, to see how extended we are, and I take that same measurement. We're right there. See that? So that to me is a key place. It doesn't mean that you go crazy going short. That to me is a key place. It doesn't mean that you go crazy going short, but it tells me, I'm not going to go long here unless it's some specific stock. But see that's exactly where the 21 EMA was back here in April, how extended it got from the 21, right there, 1272 extension. So this tells me timing wise, it's probably a good idea to start looking for a little bit of defense if you're long. And also you could start possibly looking at some really defined risk shorts if you're interested in going that direction as well. So that is what I will be watching. Now the other thing that I love to do is follow momentum, and so this is a really cool momentum indicator. I call it a momentum flow indicator. So it measures multiple time frames of momentum. Okay, so markets are made up of multiple time frames or fractal analysis. So you can't just trade on a one time frame. So you need to look at multiple time frames. So this indicator I've developed along with my other momentum indicators. It tells me when the momentum is shifting, either positive or negative, and I can set it to different time frames. So for example, this is 30 minutes, so I've got this set to 30-minute, hourly, 2-hour, and a daily time frame. So then it measures all these time frames on momentum, and you can see that when you get really max momentum one way or the other, it can give you a really good validation to direction. So for example, just looking at the S&P here, and then the other way I love to use it, and this is how I teach it to our trading course, our members. So when we get this, see this tight volatility squeeze here? So this is, you can see the momentum here, it's all green. So this top bar shows all 4 time frames are going higher. So if you get into a trade, it also really helps you to stay with the trade. It gives you the confidence to stay with that trade. Don't stop out, just trail it. So see how strong that was? And then finally right here, it started to wane a little bit. So I'm really a big proponent of momentum. So that's another thing. You'll get access to my trading tools and stuff at a members discount as well. Had some fantastic trades here, setups today on the bonds, just based on, again, on momentum. So this is another example while I'm here. You can see how strong this momentum was to the downside today on bonds. So you can see here when it broke, see this swing low right here? And it popped back up to the 21 EMA here. Now, what this helps you to do is that if you're looking to say you saw that swing low here, and you're thinking, wow, I'm going to go long bonds. Well, if you see momentum is still so strong to the downside, it keeps you from going long. And eventually, you can see that this did roll over at the 21 EMA, and then it gets you set up to go short when you break that swing low. See how hard momentum was still down? So I can put this, we'll use this on any time frame. So I'll set this to a 5-minute time frame, and I'll set my study to the 5-minute momentum flow indicator. So I've got that saved down here. I'll put that in. So this one measures the 5-minute, 15, 30-minute, and hour. Okay, so when I put this one in, you can see how strong the bonds were down earlier in the day, and we had a couple of members that just cleaned up on this trade. See this? That was that trade I was showing. That was the 30-minute chart. Here's your swing low. Now here's the 5-minute. Now look how strong that was. So when it came down to that swing low again, it said all's clear to go short again. And then you can see here, it never looked back. So once you get into the trade, you just trail your stop. You just stay with it. Just stay short, 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 short. And you see the momentum, everything's down. And just, you just go, you can just sit back and relax. And the thing about bonds, when they trend, they trend. So it's a good one. Now, one other thing I'll show you, and then see if you have any more questions, we'll call it a day. So what I like to do is monitor a bunch of different asset classes. And so we'll monitor all these, again, using this system. And then it just shows you what's going to be in play. So, we'll do swing trades, but we do a lot of futures trades too. So, kind of cover all the different angles of the market. So this, again, is my proprietary trading model, but I've got everything here set to a 5-minute time frame, okay? So then I've got my momentum flow indicator here. So I can just glance at this, and I can see, when I see these colors all lit up, I can see where to focus my attention. And then when I see something that's in what we call a volatility squeeze, that's where we're going to really focus. But you can see here, crude oil all of a sudden just got a huge amount of momentum flow coming in. That was at 9:07, about 7 o'clock. See all that? And you can see natural gas as well. So we went short today, natural gas, using a spread. So I do a lot of spreads. That's the other thing that we do, probably nobody else does, is I do a lot of spread trading futures based on my background in trading oil. Let me show you some of the spread type trade setups. Probably nobody that you've seen does this kind of trading. So this is what we call a gasoline spread. This was going long, went long gasoline RBOB in August, short heat August. Okay, so after the stats came out on Wednesday, we had a big, huge build on heating oil. We had a smaller build on gas. Look at the momentum, went straight up. So bought gasoline, sold heat as a spread. So that spread right there got in gasoline at minus 0.147 cents below heat, okay? And then just took that off today right there with gasoline went to 0.009 cents over. So that move from here to there on that spread is $1,000. Okay, so things like that. And then for the natural gas, did a short trade setup on that as a spread as well. So did this spread trade on natural gas towards the close, and let's see where that is now. So it's up a little bit. Let me pull this up. So we do gas cracks, all kinds of different spread trades. Here's the nat gas spread trade. So just a lot of fun stuff. Different from probably a lot of different trading rooms. Hold on. Okay. Computer's bogging down. So yeah, so this nat gas trade, put this on today right towards the close, right about where we are right now. But see what tends to happen is this is long December, short October. So if you get a sell-off in natural gas, the front part of the market will go down faster because that's where all the supply demand is. So this is a way to go short nat gas rather than having to be outright short. So it's a different way to play it, but it's a great way to play it. So the last time I had this trade on was right here. Put it on right back here, went long natural gas at 0.391 cents per MMBTU and took it off here at 0.409. So that's about, let's see, that's 0.409, 0.409 minus 0.391. That was about $200. I thought it was more, it was a $200 move, but that was a pretty fast move. So it's a good way to play it where you don't have to just be totally exposed directionally. So it's kind of a hedged way to trade it. All right, any other questions? All right, well, I'd just like to say thanks for everybody taking a little bit of time out of your summer. And hopefully this is some stuff that you can start incorporating into your trading tomorrow. If you have any questions, feel free to send us an email at support@PowerCycleTrading. And good luck trading. Now, tomorrow's monthly expiration. I think that we don't get a big sell-off tomorrow. I think we'll get a little bit of a pullback here over the next few days. So be aware of that. And but the market, that 2134 is a key level. So it pulls back to there. We'll probably get some kind of support. Well, thanks, Morgan. Thanks, Raleigh. And appreciate everybody being here.